Hello, fellow rebel capitalists. Hope you're well. I'm here with the one and only Stephanie Pomboy. Now, I have interviewed a lot of people on this channel, but this is probably the one person that I have just an immense amount of respect for, but I've never had the opportunity to get her on this channel. So, Stephanie Pomboy, thanks for coming on today of all days.
Oh my gosh.
The stock market was down 1,500, and all of a sudden we get fake news of the White House and it goes up by 1,000. I have never seen volatility like this in a lot longer than I have. So is this unprecedented what we're seeing today?
I mean, it's wild, but, we have a very unusual commander-in-chief who, shoots from the hip. And I guess the markets aren't really used to being on this kind of roller coaster ride. So it's probably going to be this way for a while. Oh, man.
Yeah. And I also, not to put any pressure on you, but I've got to tell you before we get going here that you are my sister's favorite macro commentator by far. You're probably her favorite 1 through 10. So I didn't tell her that I'm going to be interviewing you today. So when this goes live, I guarantee she's going to freak out. So you have a huge fan in my sister. That's for sure.
That's crazy. Well, I have to tell you that I was so flattered when you invited me, because I have always sort of figured myself to be kind of on a lower tier. So to be invited to come and chat with you, I'm like, I hope I'm on the top of my game so I can, swing and actually hit the balls that you lob in my direction.
But let's get into it. What is your view on, I can't say what are your views on tariffs, because there's so many different dynamics there. Are we talking about tariffs through the lens of just a negotiating tactic? Are we talking about tariffs through the lens of an economic policy? So I guess, what are your thoughts as we sit right here, April 7th, on the tariffs and maybe the way Trump is implementing them?
Well, I am a big picture girl. So this is why these short-term swings don't really upset me, because I generally like to step back and identify long-term themes, rather than getting whipsawed in the minute-to-minute stuff. And obviously the nature of what I do affords me the luxury of being able to do that. I understand, if you're running money and you're running a mutual fund, you've got to actually get in the trenches and deal with this stuff and identify opportunities kind of on a much more short-term basis. But as I step back and I look at the broad macro framework, I see and have seen for a long time the sort of end of the era of globalization has been, it's not a new thing. It's just been moving at sort of a glacial pace, with, the US consumer being less of the epicenter of global trade as China and other economies start to, nurture their own consumer base. And then you obviously had the de-dollarization shift by global central banks, which I think was part and parcel of that whole broader shift away from globalization, which, when I say globalization, I'm describing a world where global trade was engineered around the US consumer. It was basically, they lend us the money, we consume their goods, and that was the operating framework. So that era, I think, has been slowly receding. And then it was accelerated dramatically with Trump's election, as he sort of said, look, it's America first. We're going to reshore production. We're going to boost our manufacturing sector. We're not going to rely on the rest of the world for pharmaceuticals and all these precious resources, et cetera, et cetera. So it took what was already in place, this shift towards sort of more isolationism or mercantilism, as some people call it, and put it in warp speed. And I think the markets are now finally starting to scramble to catch up to what has been sort of an ongoing trend for a while. And so things like gold, for example, where, most people didn't pay much attention. It moved from 1,600 to 3,000. And all of a sudden at 3,000, everyone was like, oh, crap, why is gold suddenly so strong? And it was just part of this whole end of the dollar as the center of the world, end of the US consumer as the end of the world trend that had been ongoing, but that, again, was greatly accelerated with Trump's election. So that's sort of my overarching framework. And then obviously within that secular framework, you have these cyclical swings. And so, if we're going into a recession, that's going to have sort of a compounding effect in terms of this shift away from the dollar and the consumer and whatnot. And the tariff thing, I think, will be very interesting to see how that plays out from the standpoint of the inflationary impact of it, because that's, there's a raging debate around. It used to be every time you turn on the news, people would say, well, tariffs are a tax on the consumer. We're going to have higher inflation. And I think it's not that simple or clear in my view. And certainly if you go back and look at the CPI and PPI after Trump imposed tariffs in 2018, they actually were lower 12 months later. So it's not, cast in stone that the tariffs will necessarily result in higher prices here, but we will see.
That's an interesting debate because let's just assume you get a recession. And I think that we're both in the same camp here. And maybe we can talk about as to why you were in this camp, that the United States is kind of teetering on the edge prior to Trump. Mm-hmm. I mean, it's not like this is all just about the tariffs. The economy was unsound fundamentally. And
don't you think that's why he was elected?
Yeah,
was
exactly.
An expression of how bad the economy really was.
Exactly. And I go back in history and I try to find an inflationary recession, and I can't find one. It's like not a thing. And what I mean by that is a recession where you actually have the CPI accelerating. Obviously, in the 1970s, we had recessions with high rates of consumer price inflation, but that was disinflationary. Each one of those recessions, like as an example, at the beginning of I think 74 to 75, once you had that spike in the unemployment rate, you had disinflation. You had inflation coming down. So, but then, or now, you combine that with the tariffs, especially at 20%, 50%, who knows what they're going to be tomorrow.
Right.
And you say, well, that has to increase the cost of goods coming in. So I guess, Steph, is a question where you're just going to have some goods, assuming that these tariffs stay in place, are you going to have the cost of some goods going up, but that's going to rob purchasing power away from a consumer that was already strapped and waving the white flag? So then that takes purchasing power away from other things that they would have bought, because those things they have to have take a larger percentage of their paycheck. So what I see on this channel, you're kind of robbing Peter to pay Paul. So then you have economic activity declining, which therefore increases the unemployment rate, which decreases aggregate demand, and then kind of puts a cap on those prices from the stuff that we were importing. And in aggregate, that total basket may trend downward. Is that a base case maybe?
That's exactly how I would see it, is that, it's a zero-sum game. If your income isn't going up or is even declining because unemployment is rising, as you described it, then if you have to pay more for one thing, you've got to pay less for something else. Yeah. The only caveat to that is helicopter money, like we saw during COVID. So if the government suddenly decides, like Elon Musk talking about doing this Doge rebate. So if we suddenly sent out $5,000 checks to every household as a Doge rebate at the same time that tariffs are coming through, then you might see some inflationary impact of that. But even then, one presumes it would be temporary because of, once they spend that money, then all of a sudden they're back to the same situation. But I would further say that nothing cures inflation in goods like deflation in assets. So if we see the markets continue this risk-off mode, or even sustain, if we just stay where we are here and don't go back up, that hit in terms of the wealth effect, whether it's, actual or just psychological, will have a disinflationary impact on the economy. And you're already hearing these anecdotes about the high end and, the luxury goods companies and whatnot seeing some kind of retrench a little bit. So I think that is another really powerful force of disinflation, assuming that the markets continue in this sort of risk-off mode. I mean, think about it. Like in 2008-9, people forget this, but when we were going into the global financial crisis, the CPI was 5.5%. I
That's
mean,
right.
we think that we lived in an era of 2%
That's right.
inflation for our whole lives. It was 5.5. And 12 months later, it was -2. So, that destruction to asset prices just imploded goods prices. So, goods and services. So,
Yeah,
anyway, that's
it's a great point. I always talk about that on my videos, how when the Fed started cutting in 2007, the CPI, September 18th, same date, of course,
right.
the CPI was right around 3.5. And you fast forward to July of 2008, and it's 5.6. And, it's funny, Stephanie, is I always go back and look at the Wall Street journals.
The
Uh,
headlines. Yeah. Okay.
yeah, exactly.
Oh,
And I
God.
like to go back to like the August CPI report that showed, the what the CPI was doing in July, and
Right.
see that the day that it came out, the very next day, what the headlines were like in the Wall Street Journal. And they were all stagflation, inflation is back, that is
Right.
way off sides. They've been cutting too much. The economy is, overheating, and the Fed is going to have to start hiking rates. And 2 months later, the Fed funds at zero.
You can't make this stuff up, but it's one reason why it's kind of fun to collect those headlines
Yeah.
because the timing is that's when you see things where people get so worked up, like, oh my gosh, we're gonna go back to the late 70s inflation, it's gonna be crazy. You think, all right, we're probably at the peak inflation hysteria right now. People don't see how weak the economy is underneath it. I mean, I thought we were in recession for the better part of the last 2 years. And if you look at the consumer data, which I spend a considerable amount of time,
Yeah.
digging into, the average consumer has been in recession. So, I mean, you look at real consumer spending and then you look at spending excluding the things they have no choice, like healthcare and housing, and they're all deep in recession territory. And that was before all of this happened. So, again, I think that the markets have been in some kind of la la land, imagining that everything's been fine. While the average American's been struggling, and the corporate sector, we saw the largest number of corporate bankruptcy filings since the financial crisis, but no one paid any attention because there was so much of this extend and pretend going on with the companies that were actually on Wall Street's radar. That everyone was like, look, there's no problem with higher interest rates, everything's great. And I think we're now starting to open the kimono a little bit.
Yeah, I always talk on my videos about how kind of one of the moments that I've had since I started doing these videos in 2019 is that the market can go up or down in ways that have absolutely nothing to do with the fundamentals.
Yeah.
And I'm not just talking about the fundamentals of the underlying economy. I'm talking about the fundamentals of the stock market itself. And the more I do this, the more I realize how important narrative is. And if we're in a bull market, they're just going to spin the narrative to be bullish. So one day, low interest rates are good. Buy, 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 buy.
Right.
The next day, high interest rates are somehow good. Buy, 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 buy. Until you get to a point where I call it the Biden moment. And
That's so good.
You remember how he's sharp as a tack, Stephanie. Don't worry about it. And
They
how
can't
dare
keep
you
up with
say-
him. He's like doing back handsprings, and then all of a sudden he face plants in the debate. And it's like, who is this guy? We've never seen him before.
Exactly. And if you said, well, I don't know, maybe he's not so mentally sharp when he's shaking hands with the air and everything.
Right,
Like,
right.
how dare you? Or you're spreading misinformation. You're spreading
Right.
this, malinformation or whatever they're calling it at the time. And then, the mainstream media just doubles and triples down on this stuff,
Yeah.
that he's sharp as a tack. And then all of a sudden he has that debate, with Trump, where it's so obvious
Yeah.
that they're like, okay, we can't go on with the weekend at
The
Bernie's
charade.
ruse anymore. We've got to admit that this guy needs to go. And it's almost like, when do we get that moment in the stock market? And do you think the reciprocal tariffs had nothing to really do with other countries' tariffs. Do you think that could have been that big narrative shift to where now, instead of bad news being good news and good news being good news, we're in a mode where bad news is bad news and good news is also potentially bad news?
I mean, now it seems like we're slave to the tweeter in chief or whatever they call it, and every headline we're like up, down, all over the place. But it is interesting because I was saying to a client the other day that I feel like tariffs are now going to be the scapegoat for, this risk off move. Never mind that, like you said at the beginning, the fundamentals, which no one cared about forever, we're not supportive of the market anyway. But now we have a scapegoat that we can point to. So it's not that we failed to do the analysis and missed the fact that the fundamentals were never right to begin with. Now it's all about tariffs. And what prompted me to make that observation was this headline talking about all the companies that are going to go bankrupt because of the tariff thing and how it's going to create this, credit bust in the corporate market. And of course, I've been forecasting the bust in the corporate credit market forever. And I was like, damn it. Now they're going to say it's all because of tariffs. It has nothing to do with all the things I've been writing about for like 2.5 years now. No, it had nothing to do with being massively levered, having no viable business model, and then watching the Fed ratchet up rates in their faces. Like nothing to do with that. It's just tariffs.
But you can say in your favor or in your defense, Stephanie, is you can just say, look, yield curve inverted, yield curve uninverted, Fed rate cutting cycle, unemployment goes up by 50 basis points over the past 12 months. And this all happened prior to tariffs.
Right.
So that backs up what your fundamental thesis or your argument that you're just making.
Oh, yeah. And to say nothing of 24 straight months of declining leading indicators. I mean, negative real retail sales. I mean, the list goes on and on and on. But yeah, no, it's interesting how these narratives, like you're saying, are everything. And then all of a sudden when they collapse, it's like the market realizes, oh, there's only air below us, and you have that panic moment, like the Biden panic moment. It's such a great analogy. And then the question is, you get into that frenzy of, oh my God, we've got to sell everything. And so, I sit here and I'm watching gold get destroyed in this process. And I actually feel fairly zen about it because I think, this is just a reduction of leverage across the board. And so you just got to liquidate whatever you can sell, yada, yada. But I just think the case for gold is so strong and it gets stronger every day that, I wish I had a truck I could back up and load up all this gold at cheaper prices right now. But, anyway.
But let's go into that because gold, I'm not sure how much it's down today over the past week or so, but it relative to risk on assets, I mean it's holding its ground. I mean, I always say that gold is doing its job, even if it's going down. It's going down a lot less than everything else. And really, the only time when you get a big move down in gold is if you have a liquidity event. And to your point, it's the only thing on the balance sheet that these hedge funds or the pension funds or whatever can actually sell to generate the cash they need for redemptions or whatever it is. But that's always your buying opportunity, or at least it has been in the past. So I guess my question in terms of gold is, do you think we're going to get that liquidity event that could drop the price to where you'll back up the brinks because that's the buying opportunity? Or do you think that we'll just kind of grind lower as a result after these headlines kind of go away and people get accustomed to the fact that we'll have these tariffs in place for quite some time? And then that, in my view, if that does happen, we don't have that liquidity event, then gold still probably just goes higher from here.
Yeah. I mean, I think we're seeing the liquidity event right now. I don't see any fundamental reason why gold should be down $48 right now.
Okay.
Quite the contrary. I mean, I think to the extent, if you buy the framework that I suggested at the outset of this shift away from globalization toward more isolationism, and then you would see an environment of continued de-dollarization. Because what's the utility of holding dollars if you're a foreign central bank and your world doesn't revolve around trading with US consumers anymore. And the US is basically saying, we're putting up barriers. We don't really want to have anything to do with the rest of the world, in which case, we're kind of retreating both in terms of our role in the globe, but also in terms of the role the dollar therefore plays in the globe, which should inure to the benefit of gold. And then obviously, if you continue to have this risk off move, as you said, you had the liquidity event initially, but then you get to a point where gold really begins to outperform dramatically. And it has, as you noted, it outperformed stocks last year. And so far this year, it has outperformed as well. And I guess, the one thing that could change that is whether the policy response is different, because I think the reason why gold ends up moving so dramatically off the liquidation point and surging higher is that it anticipates the monetary and fiscal response that would be brought to bear to deal with the implosion in asset prices and market turmoil and the inevitable impact that will have on the economy. So, in 2008-9, you remember, I'm sure, Hank Paulson going to Congress and begging for his bazooka, which sounds quaint now. It was what, $787 billion? I mean, it's like a joke. I think Elon Musk uncovers that much fraud in a day. But so gold generally anticipates that the policymakers rushing in with the fire hoses. And to listen to Powell right now, anyway, he's saying, we don't think it's time to cut. We're worried about the inflationary impact of tariffs, yada, yada. And then good till canceled. And then, of course, on the fiscal front, everyone purports to have embraced this sort of newfound fiscal integrity where they're going to be cutting all the time. So all of which I would say is good till canceled, because, if the wheels come off like they did in 2008-9, I have to believe, I'm already getting flashbacks to 2018 when Trump was calling Powell to the White House, telling him you got to cut rates. And Powell insisted he wasn't going to do it until the market went down to the point that he blinked and became, Powell pivot. So I think I anticipate that we'll get another aggressive monetary response for sure. And then we'll go back to QE. That's long been my forecast for reasons that have nothing to do with this market meltdown. But even without the fiscal assistance, the monetary assistance alone would get gold moving right back higher again. So, I think gold it's an opportunity right now. I would say it's oversold right now.
Yeah, I've always tried to figure out what are the main drivers of the gold price. And it's just one of the most bizarre things I've ever researched, because at times you can point to inflation. At times you can point to the inverse of the dollar. At times you can point to this, you can point to that. And then there's other times that it does the complete opposite. It's the inverse. So the only conclusion I can come to is over long periods of time, gold maintains its purchasing power. That I'm confident in saying.
Yeah.
And that in short bursts or maybe over the midterm, it is a hedge against uncertainty. So one of the reasons I'm bullish, not only the chart looks great, but also because I think that regardless of what happens in 2025 or 2026, Trump's approach is to create uncertainty. That's just that's how he does business. He's a bull in a shop, and you can say that it's great for negotiation, and I'm sure it is, but you can't deny the fact that that's kind of his MO. And I think that's probably why most bullish on gold. Can you? I know you've done a lot of research on it. Do you see other correlations that maybe I haven't found?
No, I mean, I think you nailed it. I guess one relationship that I like to look at really closely, because I agree with you. I mean, I think gold kind of stopped reacting to inflation in recent years because you had this perversion where hotter inflation numbers were actually gold bearish because they were supportive of the dollar by suggesting a tighter monetary policy. So it basically was like, all right, well, if the Fed has to tighten, that's a strong dollar, therefore gold goes down. So it was the dollar more than the inflation. But like you said, it's impossible from day to day to figure it out. The one relationship that I think is really useful to look at is the gold copper ratio,
Mm,
because obviously copper, Dr. Copper is, famously the bellwether of global economic activity. And then you have gold, which I view as sort of the arbiter of financial stability.
yeah.
So you're looking at the relationship between the financial stability and economic stability. And when gold is going up relative to copper, it's telling you that, global economies are weakening and that instability is rising. And that gold copper ratio, if you go back in time, you'll see like it spiked dramatically, obviously, during the global financial crisis, again during COVID. And we're right back at those levels today. And it actually has been moving that way for, the better part of a year. So that's one I like to watch. The only problem now is if we're talking about tariffs on copper, that throws that, the utility of looking at that indicator out the window. So we'll have to see, what happens on copper specifically. But that had been kind of one I really like to watch. And actually, you could overlay it with credit spreads, and the two lines are very similar. They do move
Mm.
together where it's a real barometer of risk off, financial stability, as I said. So when your instability is rising, credit spreads are going up,
Yeah.
VIX is going up, move, volatility, all of those things seem to correspond.
And the move index, just for the viewer, is the volatility in the bond market, correct?
Correct.
Yeah.
Yes.
Okay. That's interesting. I didn't know there was a correlation between that ratio and corporate credit spreads.
Yeah, I can send you some charts on that. I'm,
Huh.
the queen of financial pornography over here, so I can send you some of that.
All right. So I know you do a lot of research on the consumer,
Mm,
on how retail is doing. Can you give us some insights as to, I mean, you kind of touched on it briefly there,
yeah.
but more recently, what's happening? And one thing that you said there that I really want to highlight is retail sales have been negative if you adjust for inflation.
Yeah.
And I cannot, for the life of me, understand why they give you the nominal retail sales. That doesn't make any sense to me whatsoever when you try to, especially when you understand why the market wants those numbers. It wants those numbers to see the health of the consumer.
Yeah.
And if they're buying, shouldn't we measure that not in currency units, but shouldn't we measure that in units actually purchased?
Yeah, it's interesting because we look at everything else in unit terms.
Yeah.
GDP, we look at the real number rather than nominal number. Even auto sales are reported in units,
Mm,
not in dollar amounts. So it is interesting. But if I take just the retail sales report that come out each month and I deflate it by the CPI, and you and I can debate how accurate the CPI is a measure of real world inflation,
right.
that shows that retail sales have gone nowhere for 2 years, actually longer than 2 years. So to me, first off, if you go back, you never have a period where real retail sales aren't growing and you're not in
Outside
a
of a
recession.
I'm
Yeah,
assuming.
you
Yeah,
have
yeah.
to be in a recession, much less for 2 years straight. I mean, that's just pretty much unheard of. So that was an indicator to me that the average consumer out there is really struggling. And it's being masked, of course, by the high end. But there are other things that are interesting. You go back to narrative a little bit. We've seen these imploding consumer sentiment and consumer confidence readings since the beginning of the year. And Zero Hedge and other outlets are saying, look, it's all Democrats who are just pissed off and unhappy, and they don't like the agenda. And so that's the problem. And, I feel like shaking them and saying, we felt the same way when they were saying, oh, it's just Republicans who don't like Biden, they don't understand Bidenomics or whatever. These people still spend money. As Mike Jordan said, they buy sneakers.
I was just going to say Michael Jordan.
Yeah. So, I mean, it's just, it's like how dumb you're basically saying half of the economy is irrelevant. I mean, we didn't like it before. So it's, anyway. But the bigger thing is if you go in and you drill in first, Republican sentiment is weakening. It's just not as bad as the Democrat sentiment is, and independents as well. So it's, there's a general sense of anxiety that's increasing. But the things that are really interesting in those surveys, both the confidence and the sentiment surveys, is that it's the outlook, not just for inflation, but for employment.
Yeah,
And
right.
if you go back and you look at the employment outlook, they anticipate the changes. So the consumer has a really good sense as to what the labor market is doing. They have a
Mm.
much early, they have a little early warning system because they're in it and they have friends and family and they see the layoffs, et cetera. And so if you overlay, the expectation for the unemployment rate with the actual unemployment rate, it leads. So to dismiss these consumer sentiment and confidence readings as just, they're just getting caught up in the headlines and the media spin is dangerous, I think, because first, as we just talked about, the consumer's already been in recession. And second, they know what's going on out there. They're seeing it, they're experiencing it. So I think that the employment picture could really sour pretty dramatically. And that could be a surprise for not just Wall Street, but for the Fed that would get them maybe to be a little bit more dovish.
Yeah, that's, I think, something that they couldn't ignore. Like right now, Powell can come out and say it's, higher for longer. We're not worried about it. We're going to keep interest rates where they are, regardless of what the stock market is doing, what Donald Trump is saying.
Right.
But I think, to your point, if they see the unemployment rate spike to 4.5 to 4.7, going up to 5%, now all of a sudden they're going to change their tune very, very quickly. It's interesting that the soft data in this case actually leads the hard data, because usually you don't see that.
Yeah. No, I mean, well, with regard to the discrete components of the soft data, like the, employment picture, and then also things like the outlook for real income, that also not surprisingly impacts consumer spending, because if you think, you're going to make less money on your job, but inflation's not going to go down, you're not running out to spend more money. You're really trying to budget as much as you can. So it does have real world impacts. It's interesting that people talk about, they dismiss the soft data, and yet everyone's talking about how people are front running tariffs. I have a friend of mine actually say, "Oh, I was thinking about buying a car. Should I buy it now before the tariffs hit?" And I'm like, "Well, first off, you're too late." So, but so that kind of narrative, which is also, I would say, kind of a soft data thing. It's just out there. It's just an idea. Has real world consequences. So, I wouldn't poo-poo these things so cavalierly.
Yeah, I had lunch the other day at a local cafe, and I live in Medellin, Colombia. And a guy comes up to me because I was wearing this shirt, and he was a fan of the channel. So he just wanted to come and say, "Oh yeah, I love your videos and all these things." And then he starts telling me that he owns a couple big businesses in Washington, D.C. and in Baltimore. And like your friend, he's a business owner. He's an entrepreneur. He doesn't pay attention to markets too much. He doesn't really understand the Fed or yield curves or any of this esoteric stuff. But I just asked him, I'm like, "Well, kind of what's going on in your business right now?" He's like, "Honestly, I'm not doing anything." He goes, "There's no way." He goes, "I just turn on my phone and I see the stock market's down, and I don't know what's going on. Like a tariff, I don't even know what a tariff is. Like I have no clue how this is going to impact my business." And therefore, basically, he's frozen. He's not hiring. He's not investing in R&D.
Yeah.
He's literally just stopping, doing nothing. If anything, reducing headcount just to be safe, just to see how this plays out. And I think that if you have, even if long-term tariffs are a net positive, if you have this in the short and midterm with businesses doing this, you're likely to also have consumers doing this, and that leads to an economic contraction.
Well, and also, and we'll get this update tomorrow, the NFIB small business survey, which obviously is important to watch, not just from the standpoint of what's going on with business, but small businesses are responsible for the bulk of the hiring. That uncertainty index has been, surging higher within that. And you assume that that's, going to weigh on, like you're saying, CapEx and hiring plans for sure. So no, I'm with you. I mean, I think that these soft data I look at very closely, because I think that they do tend to lead, at least when they're all singing from the same hymnal. It's one thing if there's some errant data point, but right now it's all so profound and pervasive that to me, it's not something that you can just dismiss. And it's not like the hard data is particularly compelling either. It's, I don't know where that employment report came from, but I've been curious as to where all the employment
payroll, but yet unemployment went up to 4.2.
Yes, true. But those employment numbers are, of all the data that the government publishes, probably the single least reliable, and that's saying something, considering the quality.
Last year they revised it down by 880,000.
I'm sorry?
Last year they revised it down by 880,000.
Yeah.
Just to prove your point.
Right.
So we talk about how the consumer was kind of already in recession. And I know you also do a lot of work on analyzing corporate balance sheets, and you talked about bankruptcies earlier. Can you give us the details as to what you have seen kind of leading up to 2025 and what you're seeing right now?
Well, it's interesting going back to the corporate sector. The consumer's been in recession, and the surprise to me for a little while was, well, how are corporate profits holding in so well?
Right.
And then I went through and, thank goodness for FactSet, because you can access free every week a digest of exactly the breakdown of S&P earnings announcements by sector and whatever. And what they were saying all of last year was that, first off, we knew that we had this skew between the Mag 7 and everything else. So you had a very small number of companies that were really generating all the earnings. When you looked at things like the consumer discretionary sector, if you took out Amazon, which I would say should be a tech company, not a consumer discretionary company, because they earn all their money with the AWS, not with the doodads that I'm buying every day on their website.
Mm-hmm.
If you take them out, consumer discretionary earnings were zero. So that sector was in recession as well. And then, of course, there are other sectors that were doing well either. And all of that was manifest in that parade of corporate bankruptcies that we saw, which obviously relate more to the smaller companies. But, this is what I think what we're seeing. Again, I like to step back 10,000 feet, is that you had this era of 0% interest rates where businesses, I'm a big Seinfeld fan, in case you didn't know that. But I think of George Costanza and that episode where he says, I'm bald, I'm unemployed, and I live with my parents. And I feel like these were companies that were, bald, unemployed, and lived with their parents. They had no prospects whatsoever. Like, these companies did not deserve to have funding to go forward. And yet, all the VCs and, all the private equity firms were they needed something to throw money at. So anyone with some harebrained idea was able to raise money. And then we had the Fed tighten, and all of a sudden you cleansed all of the sort of zombie companies that never should have existed in the first place. They got wiped off the mat. And now we're starting to call more legitimate enterprises, because this interest rate situation that everyone did the extend and pretend, hoping that, by this time rates would be a lot lower. We'd go back to 0% because that was the status. That wasn't the anomaly. That was the norm in their world. It hasn't happened. So we've got $1 trillion in debt that rolls, I think $900 billion in corporate debt that rolls this year, and then $1.2 trillion that rolls next year. So there's no relief for these corporations that took out massive amounts of debt and now have to roll it at rates that are double what they were borrowing at in the zero money era. So
where on the curve do they usually borrow, Stephanie?
Well,
they usually borrow at the front end of the 2 year, the middle of the curve, or what rate impacts them the most?
Well, what we're finding out is there was this narrative that the companies had shrewdly termed out all their issuance in that low rate environment, that they all just extended the maturity wall. And that may be true, but whatever they did to extend the maturity wall left them with almost $1 trillion to roll this year, another $0.2 trillion next year, and another trillion after that. So it's not like they certainly didn't extend out 20 years. I mean, I would say they probably did 2 and 5 year would be the area of the curve that would impact them the most. And obviously that's the area that you really don't want, 2 year right now. So I think that they're in for a world of hurt as this debt comes due and they have to roll it at higher rates. And doing so in an environment where markets are risk off, it's going to make it even harder. I mean, we've seen all of last year, I watched this parade of bankruptcies and I looked at credit spreads and they were on the mat. I mean, they just went from tight to tighter. And I thought, this is insane. Like, what's going on? How can we have all these corporate bankruptcies and no one is fleeing high yield credit? Quite the contrary. And I think that, it was this idea that, well, they'll be able to refi all of this paper at lower rates. So it's just this extended pretend. We'll keep the game going. And you flash forward and here we are, and rates haven't come down, and actually spreads are exploding higher now. So,
but see, that's an important point for the viewer, because I think the viewer, or a lot of people think, okay, well, if we get lower interest rates, it'll solve all of our problems. So all the Fed has to do is drop.
Right.
But what you're not considering there is they're not the U.S. Treasury.
Right.
Right. So there's a risk premium there. So even, let's just say the 2-year goes down by, I don't know, 50 basis points because Powell drops at the next meeting. Right. Okay, fine. But if the risk premium goes up by 75 basis points, they're still rolling over at a higher rate, regardless of what the Treasury curve is doing. That, and I would also encourage the viewer to think through, if the Fed is dropping rates by 50 basis points or 100 basis points or whatever, what does that tell you about the environment in the economy? Or what does that tell you about the strength of the economy? And then what does that tell you about the corporation's ability to pay the debt, even if they are able to roll it over? So it's not like lower interest rates are a panacea.
Yeah, quite the contrary. I mean, generally, when the Fed is slashing rates, that's when credit spreads are really blowing out, like you said, for the reasons you just outlined. So absolutely. I mean, I think it's always interesting when people talk about the Fed cutting rates as if it's going to solve the problems. But in reality, first off, they're always late to the party. So the problem is already really taken hold by the time they cut rates. And as you said, the risk off mood is going to see the credit spreads move higher. And if you look at nominal interest rates, I was just looking at the junk yield is now 8.3%. I think it was 7.3 just a couple of weeks ago. So their nominal borrowing costs are going up in the face of this maturity wall that's coming due. So it's a real problem. And of course, if the economy is slowing and their earnings are declining, then with what money are they going to pay higher interest expense? And that's why many of them will end up going bankrupt.
Stephanie, I know you got to get going here quickly. When are you a buyer of stocks?
Well, I'm just going to use the very simple Buffett metric, valuation. And by that measure, not surprisingly, and by a variety of measures, this market was more overvalued than it was at the peak of the dot-com bubble prior to the recent sell-off.
And it's still way above its average if you look at the CAPE ratio.
It absolutely is. So that was going to be my point. I think we've got a lot more pain to get to a point where I say, all right, this is a great opportunity. I mean, numerically, I think we've taken a little more than 10 trillion off the market so far. Mm-hmm. And as I computed it over the weekend, we've got another 30 trillion to go to get to that mean valuation that existed. That's the thing. I mean, these are breathtaking numbers, and you generally don't just neatly settle at the mean. You normally overshoot. So, I mean, I think we'd need to see for sure a 50% haircut before I'd say, all right, this is the opportunity of a lifetime to buy great U.S. companies cheap. And I can't wait for it, honestly. I mean, I hate to be a ghoul, but we needed to cleanse the excesses. And I think if we have the spine to take the pain and let the economy clear, let the markets clear, it's going to be brutally painful, but it could be short and just set us up for a tremendous long-term viable economic, vibrant economy, and could be a great opportunity to invest in U.S. companies. So I'm excited for it.
I completely agree. I just want to remind people that the United States is unique in the sense that there are very few economies that I know of that are completely and almost totally dependent on asset prices. So if we get asset prices coming down, that in my view would disproportionately impact the U.S. economy versus the Colombian economy. Let's say where if stocks were down by 50%, it wouldn't even make it wouldn't even make the newspapers. And the only probably group of individuals that have been propping up the economy and the retail spending has been the people that actually do own assets like the Mag 7s. So
well, how can I could just throw in, I know I do have to wrap, but the one last point would be that the wealth effect, obviously, it's the tail wagging the U.S. economy dog, but also it's going to hit, it's not just the high end, because the average person out there is exposed to this market through their 401ks, through their pensions. And these pension funds are the ones that have been buying all that low quality corporate credit. I was going to use a 4-letter word that starts with C and rhymes with rap for these last several years. And that stuff is going to go to zero. So the hole in public pensions is going to be enormous. And that's going to hurt average Americans. So the impact here of the markets deflating isn't just some fancy Wall Street guys who can't buy another Rolex. It's going to hurt everybody, unfortunately.
Yeah. Stephanie, how can people find out more about what you do?
Well, after that disappointing and depressing final send-off, I would probably be like, good riddance to you. You can go to macromavens.com and, read about me and read some sample research, or you can follow me on Twitter. And that's pretty much it. I like to maintain a low profile if possible. So
can I tell my sister you said hi?
Oh my God, please. What's her name?
Lise.
Okay. Well, hi, Lise. I'm so honored. I mean, I don't know where.
That'll make her day. That'll make her day. Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow rebel capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount, because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets, and I will see you in Orlando, May 23rd through the 25th.